What if I told you that some of the world's biggest investors regularly lend money instead of borrowing it? Most people know about stocks, but bonds often seem confusing. They're sometimes called safe investments, boring investments, or even old people investments. But what actually is a bond? Imagine your friend wants to start a business. They need $1,000 but don't want to go to the bank. Instead, they ask you, "If you lend me $1,000, I'll pay you 5% interest every year, and I'll give you your $1,000 back in 5 years." If you agree, you've just done something very similar to buying a bond. A bond is simply a loan. Instead of borrowing money from a bank, a company or a government borrows money directly from investors. That borrower could be a company like Apple, Toyota, or Coca-Cola. Or it could be a government, like Australia or the United States. Governments borrow money too. When you buy a bond, you aren't buying part of the company like you would with a stock. You're lending them money. In return, they promise to pay you interest for a certain period of time. Then, when the bond reaches its maturity date, they repay the original amount you lent them. Let's use a simple example. Imagine you buy a bond worth $1,000 that pays 5% interest every year. That means you'll receive $50 every year. 5 years later, the company also gives you back your original $1,000. So over those 5 years, you've collected 5 annual interest payments and then received your original investment back. This is one of the reasons bonds are often used to generate income, especially by retirees. So why would companies or governments borrow money this way? Because businesses need money to build factories, develop new products, expand their operations, or invest in future growth. Governments borrow money for similar reasons. They use it to build roads, schools, hospitals, public transport, and other infrastructure. But here's something important. Not all bonds are equally safe. If you're lending money to a financially strong government, there's generally a lower chance that they won't repay you. But if you're lending money to a company that's struggling financially, there's a greater risk that it may not be able to meet its obligations. And generally speaking, the more risk there is, the higher the interest rate investors expect to receive. That's why some bonds might pay 3%, while others pay 8% or even more. Another thing many people don't realize is that bond prices can change. If new bonds begin offering higher interest rates, older bonds paying lower rates become less attractive to investors. As a result, their market value can fall. That doesn't necessarily mean you'll lose money if you keep the bond until it matures, because you'll still receive the agreed interest payments and, assuming the borrower doesn't default, your original investment back. But if you choose to sell the bond before it matures, you may receive more or less than what you originally paid. This surprises a lot of people because many assume bonds never lose value. They can. It simply depends on when you sell them. So why do investors own bonds instead of putting all of their money into stocks? Because bonds generally don't move up and down as dramatically as shares. They can help reduce the overall ups and downs of an investment portfolio. Stocks are usually owned for long-term growth. Bonds are usually owned for more predictable income and greater stability. Many investors choose to own both, adjusting the balance between stocks and bonds as their goals change over time. As people get closer to retirement, they often choose to increase the percentage of bonds they own because preserving their wealth can become more important than chasing maximum growth. Of course, everyone's situation is different. So in simple terms, when you buy a stock, you're becoming a part owner of a business. When you buy a bond, you're becoming the lender. One gives you a share of future profits. The other pays you interest for lending your money. Neither investment is always better than the other. They simply serve different purposes. Understanding bonds won't make you wealthy overnight, but it will help you understand one of the biggest investment markets in the world and why millions of investors use bonds alongside stocks to build long-term wealth.